Alrighty, so this week, following on doing our case study. So this is the third week of the 4 weeks. So again, just got here a bit of an outlay of what we've been doing. So week one, we introduced it. And these videos, remember, anyone that wants to see these videos again too, they're all uploaded on the members site and the blog as well. So you can go over them, but went over the rules or what we're going to do, what we want to achieve from the case study. So last week and this week is just shorter sessions, but really just going through the actual data and just making a few obvious calls from it and seeing a few obvious things that come from the data. But then next week will actually be the real sort of exciting part of it all, system creation side of it, and adding a few indicators. I'll show you one particular indicator tonight just quickly, but next week will kind of be the exciting part, and there's some really great stuff coming out of this automatic system and some amazing things just by, even though it's an automatic system, just adding a few dynamic indicators, indicators that sort of go with the flow. So, and I'll show you that at the end of this session. I mean, like range indicators and things like that. So you're sort of applying different strategies to different markets. So even though it's an automatic system, where automatic systems lack, is that they can't sort of adjust to the changing conditions. So if you can add in a few dynamic indicators, so rather than the system remaining static or remaining still and just sort of going for the same thing over and over, you're going to go through sessions of really ups and downs if you're to do that, if you're to stay still or stay static. So where the trick is to have something that's, or from this case study, is to find something that's quite automatic, very automatic, very black and white, but with some dynamic parts within the systems. And I'll show you a little bit about what we mean towards the end of this session. But most of all those indicators and putting all the data together and sort of making sense of all the information, that will be next week, and it'll be really quite interesting. There's already some really great things coming from it. Right, so last week we went from, here's the rest of the data, went from January through to June, and then today I just want to quickly go through basically July through to October, to where we're currently at. And so what I got here is a summary sheet, and this is sort of the best way to go through it. Like I can go back through the months, for example. I can click up July there and have a look at all the individual projections. Just lagging, there we go, all the individual sort of stats, and that's all there. But what we'll focus on tonight is just going through the summary sheet. So right up the top here, I've got basically each month, within each month, how many trading days there were. So typically there's about 20 trading days in a month, but January, the first week, was missing because of the year getting started, obviously, and sometimes there's bank holidays and things like that in there. But so up there's the actual number of trading days, not including bank holidays and weekends, obviously, but tradable days. And then we've got sort of each of the actual, those that weren't here last few weeks, we've got the actual different systems. So we've got the first power fade, the first power point, first terminator, which is the opposite to the power fade. Just scrolling down, and then basically the second power fade and second terminator, meaning once you hit a power point, taking the next power point for a fade or for a terminator entry. And then hopefully you guys can see within each of those different systems that there's a whole heap of different exit targets, which we've been looking at, from set targets from 8, 10, 12, 15 up to 24. So from a small target to a larger target and seeing what happens. And then a 4-point trailing target. So that's where if the market just wants to keep on going, the stock will keep on trailing it, and it could just go forever. And there's some days that, this particular, just talking about the 4-point trailing stock for a second, there's some days where the market just goes and goes in one direction. They're the sort of days that you really obviously get some big R trades and some potential for some big trades. And it's worth having some sort of trailing stop able to be incorporated into your system somewhere, because what that allows you to do is, if the market is prepared to go, whether it's up or down, it sort of puts you in a situation where you can keep on taking advantage from it, and you don't necessarily have a set profit target. It's just the market wants to keep on going, you just keep on going with it. But there's certainly a time and a place, and you'll start to see how to use these sort of different profit targets when we start adding in some indicators. So, I think it's pretty obvious that something like a 24 tick stop or a 4-point trailing stop, you want some markets that are fairly decent, pretty good ranging markets. Whereas if you're going to have some tighter fixed stops, 8-10 ticks, they work better in those slower months, or those months where the markets are quite tight and ranging within, say, less than 10-12 points. And this is where we'll start adding in some indicators next week. I've got a daily range indicator, I've got a gap indicator. So what that does, it tells you previously what was happening within the market. Are we in a tighter market, we're in a market that's moving faster, or got a wider range? And then from that, it sort of tells you what you should be applying as far as an exit strategy. And then from that, you can start to, by adding in some indicators like that, you can start to get the best of all of these exits, because all these exits are, got their own advantages and disadvantages. Times that they're going to work really well, and times they're not going to work so well. And if you sort of have something to know when to apply the different exits, but at the same time keeping it all automatic. Okay, so that's what this case study is all about, is finding something like that, and remembering the objective of it was, it came up a couple of months ago when we started really talking about risk models and talking about how important exits are, and the fact that, and we've said this many times, but the entry is only a very small part of the system. In fact, it's something that normally takes most of the focus. An amateur trader or a new trader will focus on finding the best system entry possible, whereas it really doesn't matter. Any professional trader tells you that what really matters is you've got a complete system that you've got all the management in place, and a complete risk model outlined as well. So the case study came about from just saying, well, let's take any sort of basic entry, let's take it and get a year's worth of data, and then once we get that data, create a system around that, and find the best exit targets, and create the best risk model. And then so that's back testing, and then it's all about forward testing it as well, and taking it to the marketplace, and making sure it works in a live market as well, and sort of working your way into it. And that's what we will do once we're finished. Today we'll just go through a little bit more of the data. Next week we'll actually put through some of the systems out there. I'm going to show you a couple of different systems. There's 3-4 systems that are quite different systems that I've put together. We'll go through them next week, and as to why they work and don't work, and a few indicators, and then we'll pick one or two, probably the two that I actually utilize at the moment, and just watch them in the marketplace live for the rest of the year. Righto, so going through the data again, and now adding on we did the first 6 months of the year, now we're going to do the remaining 4 or 5 months of the year. The same sort of, the same sort of data is coming through. It's like they're really starting to show a bit of form, some of these different systems. Patterns, I suppose is the word I'm trying to use. So something like this first power fade, for example. One sec, guys, sorry. So the first power fade, for example, we looked at the first 6 months of the year, and look at these total figures over the side here. So just to point out some totals before we go through it, each of the different systems down the side here, and then on the right hand side is the total. So I've got, for example, this is the first power fade with an 8 tick stop, okay, and then going through it month by month, what the actual points it weighed was, and actual strike rate, and then over here gives a total. So the total for the 10 months from January to October, had 31% strike rate. That's its expectancy, so it's average win or loss. Okay, so this means for every trade that it took, on average, it lost 1.8 ticks. Obviously, that's not a good thing. So the expectancy is in ticks. I pointed this out to you last week, Kat. The expectancy is in ticks, but the total for the 10 months is actually in points. because it's a lot easier to see expectancy in ticks, because it's a smaller format, and then the overall points after commission is in points rather than ticks. Okay, so the first power fade from the small stop all the way to the big 4-point trailing stop for the 10 months, pretty straight. It's copping quite a hammering. You can see here it's up around 100 points loss, just about every single one of them. And within here, red months galore. Like there's hardly a profitable month. So again, this is just raw data, and something that you could take from that is basically that the opposite of a power fade is going to work well. So the opposite of a power fade is a terminator. So we'll scroll down to a terminator. So obviously the first power fade doesn't work very well. But in saying that, there is patterns within this as well, and this is sort of what we'll start to get into next week. Is what I found is when you add a few indicators. So this is where the gap plays a big role. If you actually get a night or quite a big gap between the markets, quite often the market just takes off when it opens up the next day, and that's where your power fades work really well. So if you've got a market that's got a high range, as in it's quite volatile, and it's quite a decent gap, so more than 10-point gap overnight, the chances of a power fade, the first power fade, and we're going to utilize this, working is very high, even though overall, and I'm not sure, pull me up if that doesn't make sense, I'll keep going, but what I'm saying is, from this overall data, if you're just taking every single power fade as it is, it's very, very obvious from looking at the totals over here that of all the different systems I'm looking at, this is by far the worst. In fact, if all you did was take the exact opposite, which is the terminator, you'd do quite well. You know, just literally as a system as it is. But if you break it down, look at a few things, and when I start looking at range indicators and gap indicators, when you've got a volatile market with a big gap, the market opens up the next day, it's on a roll, and the first power fade out of all of these systems actually works really well. But that sort of day might come up maybe once every 10 days or once every 20 days. But you want to have some sort of indicator that tells you when you do come across that day, you know, which is not very often, but when it comes up, this particular system works well, even though the overall system is having an absolute shocker. Does that make sense? But it'll all start to come a bit clearer next week when we go through a few things. Yep, cool. The thing about this sort of thing is it's if you just sort of put your feelers out there and just start looking for things, if you put in the time and effort, and you know, you guys are all putting in time and effort, so you know, there's no doubts that you're doing the work. But it's amazing when you set out to achieve something. You know, you might not necessarily achieve what you want to achieve straight away, but you'll come across certain things, and you start uncovering new areas, and it's amazing what you'll actually come across. So the next one, so out of all the systems, this is probably the one that's working the best, the first power fade. So if you have a look at it, and this is one that we're going to really talk about next week, is sort of utilizing a power point system. Actually, I'll even touch on it a little bit tonight at the end of tonight, but using a PowerPoint system where in tighter markets we go for an 8-tick profit target, but then when we've got bigger moving months, going for a 15-tick profit target. So, you know, going for those bigger profits. So maybe the strike rate will drop a little bit, but we're actually going to make some bigger R returns because we're going for bigger profits. But you got to pick the right time to go for bigger profits. No point going for a 15-tick profit when you're in a market that's moving, you know, not much more than double that within an entire day. You know, you set yourself, you know, you're not. It's not a wise move. But when the markets are moving 10, 15, 20 points in a day, something like a 15-tick stop can easily be achieved. So if you look over here at the total points, you can see this particular strategy, whether you're using 8-tick stop or a trailing stop, you know, you can see every single one of them very, very consistent: 30, 40, 40, 60, 10, 30. So these clearly after commission are doing very well. In fact, one of the best of them all is the 15-tick system. Okay, so sort of that mediocre profit range. It's just about double all the other systems. But the thing about this particular system is, if you have a look at it compared to these higher ones, it has probably some of the bigger losing months and some bigger drawdowns compared to the 8-tick stop. So again, what it comes back to, we talked about this quite a bit, is what is your objectives as a trader? And we spoke a little bit about this last week as well. It's sort of, what's your objectives? Even though this is the biggest R system, it has, I can tell you now, it has a lot bigger drawdowns within it. So are you able to go through periods of drawdown? Or would you prefer something with maybe a little bit less points at the end of the year, but it has a lot smoother equity curve, as in your equity curve as far as what you're making in a year isn't as steep, but it's not as volatile. Every trader is very different as to how they want to go about trading. But then, sort of what I find is most appropriate, or what's worked really well, is I add in an indicator, a daily range indicator. I'll show you this one tonight, and then we'll expand on it next week. You add in a daily range indicator. Actually, we might even do it now. I'll bring it up quickly now. I'll bring up a little bit of data to show you, but it's sort of, you have something that tells you whether you should have an 8-tick stop or a 15-tick stop, and all of a sudden you start taking the best of both worlds. In those faster moving markets, you're going for bigger profits. In those slower moving markets, you're going for tighter profits, because you just want to keep on, sort of have it ticking over. You're not going for big profits, but you want it to keep ticking over, and you're going for the higher strike rate. And then what actually happens from that, so here it is here, let's let the projection catch up. There we go. Okay, so what I've got here basically is just taking the range, the highs and the lows of every cash market, the open and the closing. So what you can do is, it's very easy just with Excel formulas to find the daily range. So I've got daily ranges here and also gaps. And then what I've done is, if you can see at the top here, average 3, average 5, average 10, average 20. So what I've done there is taken the average of the last 20 days range, and so basically added up the last 20 days divided by 20, and what that does is gives you an average range. Okay, then I go through all the different ranges and find what's one's most appropriate, and what I found is an average 10. So you take the last 10 average ranges and sort of give yourself a little figure, and it gives you a bit of a curve, or a bit like this. That's a moving average, that's got moving averages attached to it, but this one here, so up the side here, so the projection catch up, you've got, this is the range, so points, so 5 points, 10 points, 15, 20, 25, okay, and then so this is the curve from, let me bring this down a bit so we can see, there we go, you can see that, February, January, February, March, all the way through to October, November at the end here. And what happens, you can see an average of the daily range. So you can see here, beginning of the year, if you guys remember, you guys have been here since the beginning of the year, so you remember in the beginning of the year, January, February, March, we had very tight markets, and then it really started to pick up in March and April, and then right through the middle of the year, typically, this is pretty normal, but this year was quite a normal year. The averages really picked up. Look, it's gone from an average range of 10 up to above 20. Then all of a sudden, remember, the markets started hitting their highs again through that July-August period. We also had the US go on their summer break, so we saw the market really starting to drop off, and now we've seen it starting to pick up again. So the range is picking up as we're moving towards the end of the year, because everyone's come back from their summer break. So every year is quite different, and we want to know what's happening every year. But this year, as far as the trading year goes, has been quite a typical year. Slow to start off with, picks up, drops off over the summer, and then it's picking up again. Okay, so you guys see that? And then what you do is, if I can just find the data, there it is here. So the projection catch up. So this is what we're going to go into a lot more next week. I just want to sort of give you a little bit of an insight of what we're going to do. Okay, so using an average 10 range, and I also went through a few different things and found, what's the best one to go for, as in when the market's above an average range of 10, 12, 13, 14, 15, sort of plugged in all the figures and worked it out, and what came up was an average range of 14. So when I go back to this chart here, whenever it was above 14, we go for the bigger profit target. So if this makes sense, the bigger profit target. And when it's under 14, so if you imagine there's a line of 14 goes through about there, where my cursor is. So all through here, we're going for shorter, tighter stops. When we got up through here, then up through here, we're going for the bigger profit targets. And then when we drop under that average of 14 again, or that range of 14, reduce the profit targets again. So what happens is, and this is what the two look like overall, you take the 8 tick just as is, and this is what I've done rough. This is a rough, what I did, I just looked at the graph and roughly went, okay, the months of April, May, June, July and November should be going for the bigger targets, and the other months go for the smaller targets. Then I went ahead and did it more precisely and exact day for day, and changing it day to day, as in if it's exactly above 14, go for the bigger profit. If it's below, go for the smaller, and we'll go through that next week. I've got some more precise figures, but before I did that, I did some overall just by looking at the graph. I mean, okay, this month, January, February, March, tight stop, April, May, June, July, picked up, go to the bigger stop, profit target, and then August, September, October, go back to the tight stop. And you sort of just take the monthly totals of what the average indicator was telling you, and all of a sudden you blend the two systems together, and here's the totals over here. So the 8 tick system by itself, 31 points, 15 tick system by itself, 57 points, but then you blend the two together and sort of take based on the average range, and all of a sudden you get the best of both worlds, and you can actually create a better system. And this system also has the lowest drawdown as well. So that's the best of both worlds. It has great drawdown, or great limit, really limits the drawdown, but blends the two systems together and finds when to take which system to take. But what we'll do is, it's sort of all down through here. We'll go through that next week. Some more precise figures of exactly what I do and how I do it, and because we're actually going to watch it live, we'll go through that next week. Was that sort of you picking up what I'm saying there? That all makes sense as far as the daily range indicator, and adding in some indicators, and from testing, finding the best way to approach the trading. But just looking at the rest of the data, so we just deviated there as far as adding a little bit of a daily range, my daily range indicator, as to how, and this is sort of the overall data we're looking at before, remembering that the PowerPoint, how it, of all the system, it's the best. And you can see down the side here how well it did, but then you add in that indicator and blend some systems together, and you can do even better. And that's what I was talking about before, and hopefully that makes sense now, as far as having an automatic system that's quite dynamic, as opposed to something that's very static. If all you did was take the PowerPoint with a 15 tick tick or stop, or 18 tick profit target, then it probably should make money over a year, but you're going to come across some sort of period where it's going to really struggle. So if you can be a little bit more dynamic with it and add in a few things, that's the best way to move ahead. And like next year, it doesn't matter next year if, for example, it's not just the fact that this year was quite a typical year. Let's say we have a year that's quite abnormal next year, and there's, the markets are really volatile, or the markets are really tight, or whatever happens. Those indicators that we're going to talk about next week and add in, because they're dynamic, they're looking at what the market's currently doing and making a decision based on the current market. So it's not like it's based on this last 12 months. It doesn't matter what happens in the next 12 months. It takes into account the range and all sorts of different things. So from that, it can pick the best profit targets based on the actual market, and it really doesn't matter what happens in the future. It's already built into it, and that's where it's dynamic. That's how you get that make it a little bit more dynamic, rather than having a static or a standstill system, because you will go through some tougher times if they haven't got some areas like that built into it. indicators and things. The other thing is too, and this is one that you could probably look at, Kath, because I know that you came up with, actually it was your idea with the 4-point trailing stop. If you apply that, an indicator like a range indicator for one, to what you're currently doing, or even if you apply it to this PowerPoint or any scenario, and you pick something where you find a range or an indicating range that picks up on the better moving markets. So for example, let's just look at the PowerPoint one. If we just picked out from the trading range indicator that the months that the markets were moving more 15 or more, what you do is you eliminate a lot of these red months, and some of these better months, you just take the better months, and what you'd actually do is just by adding an indicator, daily range indicator, to the trailing stop, or some of these bigger ones where you just want to pick those more volatile months or volatile days, again you'd get an overall improvement in the strike rate and in the points over the year. So here we go, this is the Terminator. So this is basically the opposite to the power fade. So obviously this one you'd expect it to do well, since though the power fade did so badly. It's of course it's not just going to be the complete opposite of the power fade, because it's just the entry that's the complete opposite, but then it's what happens from there can be quite different. So just because the power fade did really badly, that you're not going to have the complete opposite. But if a power fade fails badly, you expect the Terminator to do quite well, and you can see the same sort of thing as the PowerPoint. It's got quite profitable months. There's hardly any sort of drawdown or red months. There's a lot of green months, or a lot of profitable months. And then so these two go together. So these two, the second power fade and the second Terminator. So these are a little bit different because these suit, and I know we spoke about this too, Kath, that these suit going for bigger profits, because what happens is if you're looking at the very first PowerPoint or power fade of the day, typically what happens is you can get it quite a high strike rate, but very early on the market might be a bit choppy. So you don't tend, if it is going to be a big range for the day, it's very hard to pick it up on the first PowerPoint, typically speaking, because it's quite early. Although it's still, even with the PowerPoint back up the top there, it still did well with the bigger targets. But if you're looking to constantly go for bigger targets, the second power fade or the second Terminator, a little bit more set up for it, because you think about it, in theory, that you sort of let it get a bit of that choppiness out of the way, and then normally it picks typically the market will then go on a trend. Not always the case, but what I'm trying to say is these lend themselves a little bit more to trend following. But again, it's up for interpretation, and when you back test something, you're going to find the best way to apply any of these sort of systems. But we spoke about last week how I said up till the halfway through the year, these two particular systems were struggling a little bit, but they actually came really good, and towards the back end of the year they really started to pick up. And you look at this second power fade with the big trailing stop, 4-point trailing stop, it actually made 55 points. So it really started to pick up towards the back end of the year. And you can actually see with this particular one here too, it's if you're just going for smaller targets, it's actually did quite badly. So look at it, this is quite bizarre in the fact that those, and this is what I was trying to point out before, those top ones where we talk about the first PowerPoint or the first power fade, they were quite consistent with what they do. Whether they're good or bad, they're quite consistent through the exit targets. Whereas these ones, they're very different within the exit target. So you got this particular one, 8 tick exit target, profit target, negative 50 points so far. Then you go for the trailing stop, positive 50 points. There's a 100-point difference within the system, and even the Terminator, it's sort of a bit back the front, round the other way, but same sort of thing. There's quite a difference within the different exits. But what I think will work quite well between these two, and we'll look at this closer again next week, is we've spoken this a bit, but a blend of these two systems. So if you're looking to pick up on a trend, if you just want to have something, say for example like a 24 tick stop or a 4-point trailing stop, it's really about an intraday trend following system. And sort of what you want to do is give yourself be in a situation where if a trend's going to happen, you get on it. So what you need to do is, unless you've got some sort of direction indicator, if you want to keep it quite simple, just basically enter both ways, go short and long. But then where the magic or where the system works is by having those bigger profit targets. So when one side, and get out on one side, so go short and long, whichever way it starts to go, get out on the side that fails and let the other side go for the bigger profits. And you sort of blend the two together, and you can see down here, when you blend the two together, so far it's up 26 points for the year, which, I mean, it's not too bad. Think about this 26 points, where even though it's not as good as the 55 points up here, where this really picks up is its drawdown. If you look at sort of the blend of the two systems, which is the bottom row of this one and the bottom row of this one, so these two systems we look at here, when you blend the two together, even though you get a lower strike rate or lower points than just taking the one or just taking the power fade, the drawdown is dramatically less, and actually there's not many months where it has a bad month. So when you're in a system where you're relying on trend following, so trend following, typically when you think of what a trend following system does, your R value on a trend system is going to be quite high, so big R trades, but your strike rate is really low. So you're going to have quite often you're going to have big losing streaks, but then you rely on those big winners to come back and get you back into profit. So typical of a trend following system, or this type of system, is that, yeah, you can make profit, but drawdown is a bit of an issue and can sometimes affect traders. And that's why traders quite often they like trades that are have high strike rates, because it's sort of a mental thing to start off with. They want to see themselves winning constantly. Whereas, as you move on a bit, you find trend following is actually really good. It's one of the most popular ways to trade in the world. But a big problem, not a problem, but a bit of an issue is the losing streaks or the drawdown. So something that sort of tries to rectify that a little bit is blending the two systems. So kind of circling it down here, the blend of the two, the R value drops a little bit, or the overall points drops, but the drawdown effect is really sort of diminished. And if you sort of look at the two of them each month, like just quickly looking at it now, there's -4. Yeah, so there's pretty much the worst losing month is about -6 or so, -6, 8 points, which is, for a trend following, is really good. But anyway, so that's basically the raw data, and from that you can, hopefully you guys can already see there's a few things starting to pop out. But where it'll start to really get exciting is, like I said, next week we're going to put it all together. We're going to add some daily range indicators. We're going to add some gap indicators. We're going to add some indicators that are really quite basic and easy to interpretate and easy to attach, but they make a lot of sense and are appropriate for what we do, and based on actual market data, rather than something like a Williams or a moving average indicator or something like that. It's based on actual past market data. So we'll start to add all those things in. We'll interpret this data. We'll put it into a few systems, and actually physically have, like I said, 3 or 4 systems, and we'll run them through the market live and watch them how they perform. And then also what we can do is, in the coming weeks as well, is build a complete risk model. It's like what we've talked about, sort of bring everything that we've talked about so far this year and take this raw data and get a little bit practical with it. So build the risk models around it, look at drawdown, but starting as of next week, actually, first things first is put the systems together and add a few indicators, and all this stuff will start to hopefully make more sense. And I think whether you guys, I know a lot of you guys got your own thing. Hopefully you'll learn something from it to add to your own systems, or you might use something directly from this. Or what's more important is just sort of maybe a few ideas, get a few ideas, and from there just go off and keep on researching and developing yourself as traders. Get really clear as to what your objective as a trader is and how you want to go about it. Obviously this case study is very much about automatic systems. But there's still a lot of room for discretional systems there, and everyone approaches it a little bit differently as to where they are on that discretional versus automatic scale. But the most important thing is that everything's very well planned and the risk models are very well entrenched into what you do, and that's the whole purpose of this. Basically, this next 4 weeks, or we're up to week 3 now, and then week 4 next week, is to just make it very practical what we've done so far, and this will hopefully help a lot of things click. So anyway, guys, we'll leave it there. That's week 3 done, and we'll back next week and we'll look at the systems. So we'll talk soon.